There you go. All right. So amazing morning. Let's get straight into it and have a look at these charts. So yes, so Monday we was looking at gold, okay? And gold was doing um was consolidating, was going sideways, all right? And we drew some areas and let's try and zoom out and see exactly where we was, all right? So we was I'm gonna put a vertical line exactly where we were. We were about here. Okay. We were about here on Monday, Breakfast Club. Okay. And this market we identified, if you can remember. If not, the video is there. Run it back, go and watch it. Social on YouTube. All right. We was here. Okay. And we were saying that this market in gold was ultimately going sideways. Okay. Have a look. Okay. I hope you can remember. We can ultimately say it was going sideways. Now, what we're going to do is when I could go and re-break it all down from the start, but I don't want. I want to break down something new today. But ultimately, we were saying we was near the top of this range. Let's scoot all the way out. Let me try and close some of these things. It's like my computer feels like it's struggling. It's like a regular theme right about now for some reason. All right. So we were saying that we was at the top of a range. Yeah, and even though this market was bullish, we're possibly, going to see a reaction at the top of this range if you can remember. All right. If you can't remember, like I said, the videos are there for you to watch. And what I did say is when we was looking at it, I believe, I don't remember who it was who said they wanted to analyze gold. I said the market at the moment, bearing in mind this yellow line is when we was last together, when we was last talking about it, is going sideways. All right. And I said I want an indication of what this market wants to do outside of this sideways consolidation, this sideways action. Okay. And if I draw it properly, let's try and draw it properly. I'm trying to draw it as accurately as possible. Okay. The market was in here doing the hokey cokey, backwards and forwards, backwards and forwards, backwards and forwards. And we got a little indication here of what the market might want to go and do with a closure over here. Okay. Now it's a little bit tight. It's not the greatest of closures. I'm not going to lie to you. It is not the greatest of closures. And we saw the market push outside of here. And then we saw some real volatility jump into the market. I believe there was some news around here, but we saw this market make a retracement all the way back up to 50% of the range and then decide to fall out. So the indication was correct. It gave us an indication, gave us a correction, gave us a continuation. But there was some volatility that catapulted this. Some news fundamentals are happening in the market. Now, where are we right now? Now, where we are right now is on the higher time frame. I still had this other little box where I said that this market is trading within. Have a look. If I go to my 4 hour, I'm just trying to remind you guys of how we was looking at it. Okay. Let's go to my 1 hour. Might be a bit clearer. We said that the market is trading. What's going on? Come on. This was the last big swing low before this highest point, and the market's ultimately in here trading within this range. Okay, trading within this range. Now we're down here right now, and the market once again is going sideways. All right, once again the market is going sideways, and once again what we're going to go and do, because I want to move off this now, is we want to just place our alerts either side of that range to let us know what's going on. Now we can see some equal highs that are building up above this consolidation. Look, there's 1, there's 2, there's 3. All right. Might even say that there's 4 of the market not breaking the top end of this range. Let me make it a different color so we can see what I'm talking about. Okay. Now I'm predicting that even if the market wants to go down, we might first capture the liquidity. Nam, 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 nam. Look at the imbalance. There's also some imbalance here on the 15-minute time frame. Can you see here and here? Now, we're going to go down and we're going to make sure everybody's fully well-versed and understands imbalance and the role it has in the markets, okay? The markets do not like imbalance. Some people call it inefficiency. They do not like when price moves when the market moves through a price point too quickly and leaves this imbalance. An imbalance is that you have three candles and those two outside candles do not overlap in any way, shape, or form, whether it's wicks, whether it's bodies. That is an imbalance. I'm going to say that one more time. You have three candles. The two outer candles of those three, in any direction, whether it's bullish or bearish, the two outer candles do not overlap in any way, shape, or form. So let me give you some examples of this. Okay. I don't know why my whole screen, everything's struggling. Let me shut some stuff down. Let me get rid of my Skype for now. Start throwing some stuff overboard. Skip the use well. All right, look. Like for example, can you see these three candles here? Let me zoom in. Use my little zoom. All right. So these three, let's imagine that you pick these three candles. The two outer candles would be this candle and this candle. And if nothing of them overlaps, whether it's body or width, they create a gap. And that gap we call it as an imbalance. And that's what's identified here by this gray box. Let's pick the next three candles. So therefore, it's going to be this one, number 2, and number 3. Can you see how the two outer candles do overlap? Because this wick comes all the way over here, and this wick over here comes all the way down here. There is no gap. There is no imbalance or inefficiency in here. Yeah, let's go and pick the next three candles. This is just an example so you can understand these. All right. 1, 2, 3. These outer candles, this one and this one, if you see in between here, there is an ever so slight, look, little kind of imbalance in here, in between those two. That's an imbalance. It's a bit of an inefficiency in the market. Now, obviously, the bigger the inefficiency, the more attractive. And an inefficiency or imbalance is like a magnet to price. All right. It's a magnet. It's not necessarily a wall, but it's a magnet to price. Look how price right now. No, that's cool. I saw price moving through that place. All right. But that is an imbalance in there. Now, if you don't believe me, or you'll find it hard to do for yourself, there is a tool you can use. That tool here, if you in your indicators, is called this one here, Fair Value Gap by Spaceman BTC. Okay. Now, when you use this tool over here, it will just highlight all of those imbalances and all of those gaps. All right. So when you think to yourself, oh, I can't really see it, that tool is going to highlight it. All right. Now, watch, I'm going to switch it on and off so you can see it. I do not know why my computer's moving so slow. But can you see that same one that I identified, which is the gray, that little gray box up here? It's identifying a little bit better, a little bit more accurately. Can you see it with a green box? If I deleted my one, it's showing you that gap. Have a look. I'm gonna flick it on and off. And you can use this if you want. The thing is with this is that when you change time frames, it will also, it will change. It will leave. So as you change time frames, we'll move off of this. All right. Now the whole point is understanding that the market doesn't like inefficiency, and also the market likes to trade towards liquidity. Okay. Now, the point is with this, what people don't understand is they go, okay, well, once I find the liquidity, that's cool. But there is liquidity everywhere. After the market goes and trades and takes that liquidity, let me turn this off, because you can see it identifying lots of different imbalances there. Can you see? Red for everything below price, green for everything above price. All right. If you want to use it, I suppose for beginners, you can use it, but you have to get accustomed to seeing it for yourself with your eye and drawing it in. Okay. But you can use it. I'm flicking it on and off so you can see what it's doing. All right. Now, struggling to drag the screen across. Now, right now, XAU USD gold, all right, is going sideways in this range. Okay, it was making these equal highs relatively. Can you see if I pull this down and make it a bit more accurate? 1, 2, 3, and we understand that when we see these equal highs, when we see the ceiling that cannot be broken, all right, or people believe that it cannot be broken, it creates liquidity, all right, liquidity, which is a pool of money, yeah, where the market is attracted to. If you as a thief and you're trying to take money from the other your opponent, and that's what the markets are, it's a zero-sum game. If I win, you lose. Or if I win, someone else has to take the other side of my trade. So if I understand there's a big pool of money here, okay, these markets want to eat that money. Yeah, they want to come up here and they want to take that liquidity. And more times out of 10, you see liquidity be taken and then the markets run in the opposite direction. So I'm going to place my alerts, have a look, above this level here. I'm going to right click. My computer allows me to for some reason. Click my alert over here. I want it to alert me when it's crossing up. And I also want one beneath. Okay, just in case everything I'm saying is fraff, it doesn't care, decides it wants to start pushing down. Okay, no problem. Give me an alert when the market starts to go down over here. Crossing down. Create. And that's it. I'm done. I'm done with this market because I'm going to wait for one of those alerts to ring for it to inform me of what the market on a much bigger picture. Have a look. After being very, very bullish, if I go to my 4-hour, see, after being very, very bullish and pushing up and up and up and up within those two orange lines, if you can't see which ones I'm talking about, it's that thicker orange line. And it's also this thicker orange line over here. I'd like to see this market run back down towards this orange line. It will make sense to me. Okay, it will make sense to me. However, I can't will it just because that's what I'd like to see. I can't just make that happen with my mind. I have to read and react to what the market does. Because the market could decide to come all the way back up in here and consolidate back within this gray box that I drew. It could decide to do that for the next 2 weeks if it wants to. Just keep going up and down, up and down, up and down in here. So I can't just say, yeah, it's coming down now, so therefore I'm just hitting the button for a sell. I cannot. I have to say, okay, I am watching what the market does, and I'm going to read and react to it. Let me delete some historical bits off here. Get rid of this line, get rid of this line, get rid of this line, get rid of the Breakfast Club on Monday that we was just talking about. These little dots that are here, I'd like to get rid of those as well. Get rid of you. And I'd like to get rid of you. And then what I'm going to do is I'm going to put another line in here. No, I'm not going to leave it as it is because the market right now has made lower low, lower high, lower low. This is the lowest point so far. So the market's ultimately trading within here and here. That's what the market's trading within on a 1 hour time frame. That is a 1 hour swing high and 1 hour low over here. And the market's trading within there and consolidating within there. I want to know when the market does something else out of here and ultimately breaks down below this 1 hour low for another little impulse push, yeah, or decides it wants to come back up in here, right? So like I said, those alerts are in. I don't need to do any more with it. I don't need to waste any more time with it. I need to keep it shuffling. I'm just going to place one more alert here. No, I'm not going to bother, in fact. All right, so let me get rid of this. Any questions about what I've just said in regards to this market? Are we completely lost in regards to why I'm saying that I think it might do that? Are we complete? Does anyone want me to run back over anything to do with the strategy, understanding what I've just said? This market is overall bullish. All right, on a higher time frame, it's an overall bullish market. It is gold. All right, we understand gold has been making higher highs and higher lows, but it's really overextended here. Really been pushing here, making higher highs and higher lows, and within that run. Historically, within that run, that orange little guide, the orange little path is how it's been moving on its journey bullish. It's been historically moving up within that orange line and then coming back down and touching the orange line and pushing back up and touching the top of the orange line. Historically. Now, it might not be finished pushing up to this orange line, because remember, this orange line is just an orange line that I've drawn on my screen. Are the angles perfect? No. Are they in the perfect? No. They're a guide, okay? However, the guide is giving me some sort of, idea what might happen, yeah? And therefore, I'm looking at it in that light, thinking to myself, okay, the market's traded within this little range. This is what might happen. However, I still must trade what actually happens. I still must read and react to what the market does, because I'm not trading these markets on a, like a swing trader looking at, daily, weekly, and monthly candles. I'm trading it as a day trader, which has the volatility and the movements of the day. Yeah, they have movements and things that are going on a daily basis, and those movements are enough to stop me out, or they're enough to make me a lot of money if I can get in on the right side of them. So though I'm looking here and I'm seeing this structure on a larger time frame, you can't see it that well on a 4 hour, but you can see where I've previously drawn these lines. Yeah, it's probably missing a couple lines. I can see, maybe in here also. Okay. And I want this market on the bigger picture to start saying, yeah, it's breaking down and it's going to start breaking these levels. It's not doing that at the moment. It's actually doing the hokey cokey right on the bottom of one of those kind of areas. Just actually come down here and just thinking about it. Now, there's many reasons why the market might be thinking about it. Okay. One of those reasons are going to be looking in here and understanding that there's news happening in the world. All right. And on that news, it might be the case that the market is waiting for something before it makes this, makes this action. Yeah. So today is Wednesday. We can see that there's lots of GBP news that has already happened. And there's no other red folder USD news today, which might mean the trading is just calm. But tomorrow gets hectic. All right. Tomorrow there's a lot of things happening. All this red folder news, maybe the market could decide that for the whole day it wants to sit around and wait for after some of this news happens. Okay. If Al gets on the call, we'll ask him about further information about that news. But the reality is that's why you have to be nimble, reading and reacting to what the market does. And when the market gives you something, you must be grateful. Take the monies and run. Take the money and be like, thank you very much. Yeah, we do have the tendency, and I've had this problem in my trading, of holding trades to the point where you think to yourself, yeah, that's it. Just going to space. Yeah, and I'm going to stay in there for the next week. And, I'm going to look back at it in a week's time and it's 10,000 pips down. Well, yeah, possibly. Or possibly not. And if you're in the game of trying to make money every single day and being grateful for what's given to you, you have to understand when you've won. So let's give you an indication of winning. This is a great question, yeah, or a great principle that we can go by to try and help us in our trading. Let me ask you guys a simple question. Most of you lot on the call work, okay? You work. You go to work. So you go to work for what's that? 9 to 5? What's that? 8 hours? 8 hours, 9 to 5. But obviously you leave your house prior to that, maybe an hour each side to get home. All right. So what's that? 8, 9, 10 hours. Yeah. So you're out your house every single day for 10 hours. Some people are able to work from home, but you get my point generally. Yeah. Now, for those 10 hours, I want you to ask yourself, it's your own personal question of how much money do you make a day? All right. How much money do you make a day? Now, is that, I don't know what that is. Is that 200 quid? All right. If that was 200 quid, that is working out to £1,000 a week. I'm doing very general, sums, £4,000 a month. All right. Now, the average guy doesn't earn £4,000 a month. Just putting it out there. All right. But let's just imagine it's 200 quid a day. If you're in a trade and you've got £100,000 account for argument's sake, or whatever account is, and you risked $100 and you looked at the money and you was up $300, meaning that you've made $200. So you've made $300 plus the $100 that you risked is no longer at risk. You're going to put that back in your pocket. Have you won? Have you won? Especially if that happened in I don't know, half hour, an hour. I think you've won. I think you've just made yourself $300. Now, of course, it'd be nice to see that $300 run into $3 grand, $30 grand, 300 grand, 3 million. But when have you won? This is what you have to ask yourself. So this is a calculation an equation that you can create. You can say this, okay, I'm going to put in £1,000 of my real money. Let's say I'm going to put in £1,000 of my real money into a trading account. Let's do the math. All right. So if you're in here with your £1,000, £1,000 of your real hard-earned capital. This isn't a prop firm. I'm just using this as an example. All right. And you understand that Jay said that you should only be risking between up to let's say 2% of that money at any one time. All right. So that means you're only ever risking £10 at a time as 1% and £20 at a time as 2%. All right. So let's just go for 2% for now. All right. Of your actual account money. So you're risking £20 at a time. 2%. My computer's moving just so slow. All right. Equals £20. Okay, at a time. And you take a trade and it goes for a 1 to 5. All right. You take a trade and it goes for a 1 to 5. You mean you risked £20 and you made £100. Have you won? Well, I think you've won. You've just made 5 times the amount you've risked in one day. Yeah, or in one trade. Now, you see, even though someone might be comparing it to, yeah, but I make more money than this going to work every single day. Yeah, but you're working for 10 hours. Yeah, and ultimately, someone says, well, when I go to work, I don't risk anything. Well, you do. You pay money for lunch. You pay money for travel. Yeah, you risk the time that you will never get back in your life to go and work for this person or this company. This is all risk. And then you balance it out with a reward of what you get paid or what you're achieving in your work. So it's the same when it comes to these markets. And if you could turn around and you had that 1 to 5 return daily on your efforts of going to work, that would be a great job. It'd be a great job if you put in, one effort and every single day you was getting back 5. You was having a 5 multiple on your efforts. You was working on a project and it gave you 5 times that, enjoyment, that fulfillment. Or you're working on something and that would be you winning. Now, it's nobody's business, the fact that you only had £1,000 to start your journey. That's not my business. That's your business. That's your concern that you only had £1,000. Because if you had 10 grand and you was only risking 2% at a time, well, then you would have just made £1,000 for the day. And how much people are out here making £1,000 a day from their employed work? Would that be you winning? Now, maybe I'm getting carried away with this 1 to 5. Cool, just drop it down. Let's say you didn't do a 1 to 5. Let's just say that you was a bit more, realistic, and you did that. Well, that's still 600 quid in a day. So you need to ask yourself, what amount of money, what results, what is winning for you? Maybe you're going to turn and say, Jay, I'm not going to lie to you. I've been doing my demo account. I've hardly taken a 1 to 3 trade, but I do take 1 to 2 trades. Okay. And I am able to start my account with £10,000 for argument's sake. This is real money. This is a real money conversation. All right. And therefore, when I hit £400 for the day, I'm net positive. I'm happy with that. That's a win for me because that's £2,000 a week and £8,000 a month on a 5-day week. And I'm happy with that. We must be able to understand what winning looks like. And it's very hard for some people when we're making comparisons, when we've got delusions of, going straight to Bond Street and buying, I don't know, £800 white t-shirts from Balenciaga. When we've got these delusions of these are the things we're trying to achieve, then this can, it can warp our understanding of what trading is doing. Because let me tell you something, the big hedge funds and the successful traders are not out here trying to make 20% a month from their money. I've explained this multiple times, but yet I still hear people turning around and saying that they're finding it very, very difficult to trade profitably. That's impossible. It's impossible for you to turn around and say you find it difficult to trade profitably, because the way in which you do it is you just drop your risk down to such a small amount of risk. You wouldn't risk 1%. You'd risk 0.1%. I know, and we all know, that human nature is you don't have enough patience and resilience to only be risking something like 0.1 or 0.01% and take enough trades to get profitable. Meaning that even when you lose, you got enough in there to get profitable. That's human nature. You just don't have that type of resilience. So that's why we turn around and we say, okay, 1%. 1% is not bad. 2% is not, that's what you should be trying to risk. And therefore, when you're trading like that, when you get these profits, so if you turn around and say, I've taken a great 1 to 2 trade and you're £400 net positive for the day, you need to ask yourself if that is winning to you. If it's not winning to you, fine. I cannot turn around and tell you what is winning. All right. If that is not winning for you, and let me say how you work out whether it's winning or not, is you have tested it. You have had a demo account, and you can remember when you had your demo account and you was $400 up. You can remember when you was $600 up in that account. And instead of stopping and saying, you know what, I've won for the day, let me go to bed with a smile on my face and wake up for the next day for new opportunities. You continue trading, and this $600 or 600 quid started going backwards. 400, you lost, took a trade free. 200, you took another loss. 0, you're back to square one. Okay, minus 400 now because you did a madness. And you're sitting there kicking yourself saying, I was up 600 today. If you've ever been to the casino, it's the same feeling. You're in the casino, you're up. You just made X amount of money, and instead of you saying, yep, let me go home because the casino's going to be here tomorrow, you just kept going because you just didn't understand what winning looked like. And you was up $10,000 in the pound in the casino, and then you left 900 quid down. And all you can remember at that point when you're leaving the casino is, I remember when I was 10K up for the day. Forget about at the time in the casino, you was like, I'm going for 100K. I'm going for 200K. But when you're leaving that casino minus 900 quid and you've got phone bill and 2 parking tickets sitting at home, all you can remember is you was up 10 grand. So what is my point? What am I trying to get to you? I'm trying to say to you, especially now, even if we want to put this now to the funded challenges, if you look at your funded challenge like you are not trying to pass it in a day, that you've gone and got a 100K account for argument's sake, and you're not trying to pass it in a day, you've got to make 10% to pass the first part of that challenge. All right. And you're only going to be trading at, for argument's sake, 1 or 2% of what you're able to lose. So what you're able to lose in a 100 grand account is 10 grand. All right. So therefore, 1 or 2% of 10 grand is about $100 to $200. Now let's imagine that I'm not trying to pass this challenge. My target is 10,000. I'm not trying to pass it in a day. I'm saying, you know what? I'm going to pass this challenge over the next month or so. Now, if I divide that up, how much money a day makes me stay on target to try and pass that? And the reality is, even if you was turning around and every single day you was doing a 1 to 3. Just pull up the calculator. Because this is a numbers game, guys. It's about the numbers. It's about understanding the numbers. All right. So here's the calculator. So if I could do 600 quid a day, 10,000 divided by 600 means that I passed my challenge in 2 weeks. A little over 2 weeks, or a little over 16 days, I should say, because the weekends we're not trading Forex. That doesn't sound too bad. That doesn't sound too bad. All right, let's make it a little bit simpler than that. You didn't get 1 to 3 because obviously you've taken some losses and whatever it may be. So you're just trying to look to see if you can catch a good trade and make $400 a day. Okay. You just want to make, you've got your 10,000, £100,000 account or dollar account, and all you're trying to do is make $400 because it's not in pounds, but I've got it pounds anyway. $400 a day. So you're going to do your 10,000, which is your first part of your challenge, divided by 400. In less than a month, you pass your first phase. Now, does this seem simpler than you turn around thinking to yourself, oh, I've got to make 10 grand. Got to make that 10 grand today. If you manage your own expectations and go, I'm going to pass my first challenge with no stress, just trying to make 400 euros or dollars a day. And how that $400, how you want that to look, however you want that to look, whether that is you're taking trades at 1%, I don't know why I've got 7 in there for some reason, all right? Whether you're taking trades at 1% or 2% or 0.5% risk, or 0.5% risk. Look at this. If I turn around and say, you know what, I really don't want to blow this account. I don't have the money to go and buy another FTMO account. I'm only going to be risking every single trade $50. Okay, which is 0.5%, not of 100,000. It's 0.5% of what you're able to lose, and what you're able to lose in a 400 and 100,000 pounds account and the prop firm is 10%. Yeah, so that is 10,000. 10% of 10,000 would be 1,000, and 1% of that of 10,000 would be 100. So therefore, 0.5% would be $50. Now, even if you're just trading at 0.5% of time, look, your target's only $400 for the day. This is a one trade that gave you a 1 to 4, or a 2 trades that gave you 1 to 2. And then you're done for the day because you made $400 and you know that you're on target, that within the next 25 days, if you keep that up, you would have passed your challenge. Now, some of these days, you're going to have better days, and this is going to fly up past the 1 to 2. You're going to be like, oh my gosh, Jay, I blinked and it got to a 1 to 10. But let me tell you something. As soon as you get to that 1 to 2, what should you be doing in regards to your stop loss? If you've got a target understanding that you can pass your challenge in 25 days, if you're in a trade and you got to your $400 for the day, what would be the clever thing to do your stop loss? Even if that trade was rallying up and going to space, what would be the clever thing to do? If I'm in a trade and I understand that at worst case scenario, I've got to make $400, what would be the clever thing for me to do?
Set your stop loss so it doesn't dip below that $400 mark. That's
it. I'm taking my trade. As soon as I hit that number there, I am moving my stop and securing in that $400. As soon as I do that, and look, this is it. I'm giving it as an example. But you've taken this trade here. I just do not know why my computer's moving so mad. But the devil's a liar. All right, so let's just do that. I'm in that trade now. As soon as that trade gets up to here, boom, I'm moving my stop, knowing that I've just secured in my target for the day. Worst case scenario, boom. Now, when that trade continues running in your direction, by all means, keep securing in some more money, because you know what you're doing by doing that? You're dropping those days from 25. You're dropping them down to 22 days. If you lock in this profit over here, you're dropping it down to 20 days. You're dropping it. If that trade starts going into a monstrous trade, you've just dropped down your time of being able to pass that challenge in a short space of time. But I'm just trying to give you guys this kind of business-like, methodical approach to how you're going to pass your challenge, or how you should be thinking about growing your wealth. Because I'm going to say it to you one more time. These traders, we watched a few of these podcasts. The other guy was turning around and said that he aims for, I'm sure it was 2% a month. It might be 2% or 4% a month on his account. Bearing in mind, he's a guy who's been at the top of FTMO's leaderboard, XYZ, blah, 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 and he manages 4 million in capital. He said he aims for, let's just go for 4%. I'm sure it was 2%. Let's go for 4% a month. That's less than the challenge is asking from you to do. So the whole point is like this. That's why every single morning we're out here, we're drilling, doing these drills, so that you can understand what a good trade is from a bad trade. So you can understand how to get out of your trade and how to get in. How you make more money in this trading game is by controlling more money. Not by taking more risk, not by getting in more Telegram groups, not by, mastering 85 different strategies. It's by understanding one thing very well, inside and out. And that thing for me and for us is market structure and price action. And then ultimately being able to control more money. Even if you turn and say, look, I can comfortably make 2% a day. I know there's some traders on this call right now that have been trading for a long enough time that can turn around and say, look, I can comfortably make 2% a day or 1% a day. Comfortably, I can make 1% a day. If you could, whatever that number is, cool. That's your number then, bro. That's your speed. You've got a 1.2. Cool. Because man who got 1.2 and man who got 2-liter car, the 1.2 is still going to get to the destination. That's their speed. And they're traveling safely. When someone jumps out in the road and you're 1.2 and you're only doing 40 miles per hour, boom, you can just brake without licking man down. If you're in the 2-liter car or 2.5 and you're going nuts and you're driving that, when someone jumps out in the road, there's a higher risk you're going to lick them down. And that's going to mess up your journey. That's going to mess you up getting to your destination on time if you lick somebody down. So don't feel as though you need to sprint to success. Understand that you must be comfortable and understand the maths of what you're trying to achieve. You know what they say? If you do not know where your destination is, how are you going to get there? How are you going to get to your destination if you don't know what that destination is? How are you going to jump into a trade if you don't understand at what point you have won in that trade, whereby you should either be moving your stop loss or taking your profits? How? You're just in there, just willy-nilly, just hoping that, I don't know, some miracle happens and your trade goes, 100x, but it's not going to go 100x. Why isn't it going to go 100x? Because historically, we haven't seen this happening. Historically, when the market's going to go up here, afterwards, we see it coming back down here. When the market pushes up here, we see it going sideways in here. Like we understand that this market, this is what happens. We understand that right now we've pushed all the way up here, close to the top of this orange range. I might have to try and draw this better to see if I'm way off. Yeah, but we understand there's a possibility that this market, we don't know yet because it hasn't broken this major bit of structure, but there's a possibility that this market here wants to start coming in this direction. But if we don't see that break in structure, well, maybe the market hasn't finished going up yet, because it is still, have a look at market structure and price action, it is still making higher highs, higher lows. My computer's struggling, so bear with me. Higher highs, higher lows. I think this is trading view. Can't be my computer moving like this. Like I'm on a Amstrad or something, yeah? Higher lows, higher highs. Where we are right now, we're still at a higher low level. And we haven't broken this structure yet. And if we haven't broken this structure, then we do not know if it wants to start making lower lows and lower highs. This is basic. This is a basic fundamental understanding of market structure and price action. Man, I say I'm selling this chart. Why are you selling it? On what basis right now at the bottom of a range, near the bottom of the structure, can you just say I'm selling it? You can't. It has to show you something first. Maybe on a smaller time frame, it's broken smaller structure, and that's cool. But on this time frame that I'm looking at right now, I can't just definitively say this market's going to go down because it hasn't told me that. It's made a big old retracement all the way back down to the structure. But like I just said, or I said previously, if it wants to, this market can decide that it wants to go sideways in here for the next 2 weeks, because it still wouldn't have broken this structure. Yeah, and though you might say, oh, I can't really see the structure, I'm finding it hard. Look, you need to work on zooming in and out of your time frames to just very, very simply connect the dots. Let's go to another pair real quick. Let's go. Somebody call a pair, any pair. We're going to break it down. Pick a pair, any pair. Pick a pair, any pair. We're going to go and look at it. All right, I've got my alerts in there. I don't want to keep going on about this one.
GBP to the euro.
GBP or Euro GBP? Euro GBP. All right. We're going to go and look at it, Oanda. And we're going to, very first thing that we understand what we have to do, let me kind of delete some stuff. The very first thing that we understand that we must do is we must look at our Russian dollar. We must look at what the bigger picture, what's happening in the bigger picture, and then move down from that bigger picture. So Euro GBP, you've never traded it before, you've never seen it, never heard of it before. You're going to go and you're going to go, okay, what has this market been doing? You have to ask that question. It's a logical, common sense question. It's not like, whoa, this is really getting techie. No, if somebody said to me, Jay, I want you to invest in my business, it's called Dyer Enterprises, I'd say, all right, so what have they done? What have you done in the past? What's the numbers? Show me. Or let me see your let me see your products that you've created. Or let me see some testimonies from previous, people that have been on your, that's what I'd say. That's what I'd ask. It's not a dumb question. So you want me to invest today? Okay, let me know what you've been doing. So when I'm zooming out right now and I'm saying, okay, I can just draw some lines in here. Now these lines are just guides. It doesn't mean that just because this market back in 2003 or wherever it was doing this, that it's going to, that things haven't changed in the world. Things have definitely changed in the world over the last 20 years in this instance, okay? But I still need some sort of basis to say, show me the numbers there, of Dyer Enterprises back in the day. And he's going to start putting up some numbers from back in the day, and they're going to be terrible. I'm going to say, what happened here? You're going to say, oh, well, basically, this is when we was doing food to residential buyers or just to individual buyers. But now we've moved. We can see that in 2013 we moved to servicing businesses, and that's when our profits picked up, and that's why the opportunity is great right now. Okay, cool, that makes sense. I understand. I still got to base my opinion on something. All right. So right here, I'm looking at this chart, and I can see the market made a higher high. Boom, all the way up here. This is the all-time high over here. All-time high of this market. Okay. And then I can see that the market here, look, that the euro was getting weak against the pound, making lower lows and lower highs and lower lows and lower highs and lower. This isn't my opinion. This is a fact. Yeah. And then the market came all the way down to this level in here. Yeah. And then we started to see that the euro gaining strength against the pound, making higher highs or making highs, lows, higher lows, all the way to this point over here where we saw some wick action all the way up in here. And then we've kind of seen this market kind of, if we really want to go from about 2018, kind of seen this market just thinking about who's winning the battle, kind of doing a little tug of war in here. All right. This is not my opinion. This is a fact based upon historical data. Okay. Now, every single one of these candles are a month in time, which is a long time. It means that there's still lots of money to be made within these price action. But this is just generally what I'm saying. So generally, I know this information. Now I want to zoom in. I'm going to go down to my daily. This is the Russian doll. So I've assessed that biggest doll. I know the shape of that biggest doll. I know where the head is. I know where the foot is. I'm like, okay, cool. Now within that energy, have a look. That little box. Can you see that little box that I drew? How the market's been ping, pong, ping, pong, ping, pong, ping within that box. I need to understand when it's pinging and when it's ponging to see whether there's any opportunities for me to take a trade. So I can see here how the market was down here and the market was bullish at a point. Okay, making some higher highs, higher lows, a big old, who knows, this could have been some news or something happened, higher high, higher low, and pushed all the way up in here. And then something changed over here and sellers was like, no, we're not interested in doing that no more. And then we started to make some, lower lows and lower highs, lower lows and lower highs. And potentially, if I was to pull out a bottom end, which I'm just going to hold control and make a parallel line within that range. Yeah. Potentially, if my computer can stop, potentially this market wants to get down to this bottom yellow line. Yeah. Now, my only concern is within that range that I've drawn is that the bottom of the range is buy territory. As we understand, we want to buy when things are low. The top of this range is sell territory. So at the moment, even though I'm thinking to myself that there may be an opportunity to sell into this level, it's a bit contradictory from a much bigger time frame perspective, because I'm selling into an area that I'm saying is the bottom of the range where I should be buying from. Look, I should be buying from the bottom of the range. Look, I should be buying from the bottom of the range. Look, every time it was down here, it went to space. When it was down here, it went to space. So me selling into that level, unless I can get in a much smaller time frame and see a great opportunity, has this little bit of a contradiction in the back of my mind. Like, oh, I know I'm kind of selling down into a level that may be buy territory. But we are so far out on the daily time frame, and me as a day trader, I want to get in and out of the markets in 5 minutes, 10 minutes, an hour, that there still might be an opportunity here. So I'm going to still look at it. But I know the bigger time frame, that bigger Russian doll, that we're getting near the feet of that Russian doll. I know we're getting near to the wall of that Russian doll that might throw prices in the opposite direction. Now let's see what's going on right here on a smaller time frame, or zooming in a bit. We can see that within this range that I've drawn, you can see the market was up here Then it made a lower low. Lower than what? Lower than all this previous structure. Lower than this previous structure. And then it made a lower high. Lower than what? Oh, lower than this previous high. All right. And then we're here at the moment, like halfway through the journey, potentially off making a lower low. So that's now coloring my opinions once again. So we're halfway through the journey of making that lower low. Now, my concerns, who can see any immediate concerns that I'm going to point out just based upon where I'd like to buy from? What's an immediate concern at the moment of where we currently are in price? What's an immediate concern?
In the middle of the range.
In the middle of the range. So in the middle of this range, we're neither in a premium or we're in a discount. So that means we could go either way. What does that mean in English, in normal basic terms? It means that the Air Force Ones, which are normally 100 quid, I go to the shop and they're 100 quid. So I'm like, yeah, do I need Air Force Ones? I already know. Should I buy them? Should I know? I don't know. Maybe I'll buy it. Maybe if I had a box of them, I'll sell them at 100. If I had a whole box at home, I had 100 of them in the box, and I was like, I don't mind selling 100, making a small profit margin. Or maybe I say, no, I don't want to buy them. Or maybe I want to buy more instead of sell because they're just at that middle price. Who gives a damn? Whereas if they were all the way up here and I'm like, whoa, Air Force One's 150 quid at the moment, and I've got a box of them at home, but I only paid 80 quid per pair, then I'm like, I might want to sell right now to get my money up to get a little profits. Or vice versa. If they're only 100 quid and I'm sitting there like, right, I need some Air Force Ones because I think to myself, for whatever reason, I think that, they're going to go up in price. I might say, I want to buy right now. You see, when you break it down into these simple concepts in your mind, immediately now, when you're looking at this chart, you're thinking to yourself, I don't know. Like, do I really want to get involved here? I really wanted to get involved when it was expensive. That's when I really wanted to sell. Or I really wanted to buy when they were quite cheap. That is a basic explanation for you to understand, at least on a market structure and price action level, of what it is that you may want to do. Now, I'm not trying to say that there's not still opportunities. We're still on a daily. But on this daily right now, I'm going to have to do this. Have a look. Because the market only does one of three things. Bullish, bearish, sideways. Well, in here, this looks like the market's going sideways to me, and I haven't even zoomed in. But it looks like that market is in there going sideways. Let's drop our time frame and have a look. Looks pretty sideways to me. It looks pretty hokey-cokey to me. So once again, not that I really want to, because I don't think this is a 10 out of 10 trade at all. But even here, I understand that the top of this range is sell territory. The bottom of this range is buy territory. But I also understand that all of these times that this market's been coming up here and couldn't break it, what has been building up either side of that range?
Liquidity.
Exactly. So in the bottom of my mind, I'm thinking to myself, even if I did get in at one of these levels, I know at some point, that this market, even if it wants to go down, this market might do this first. Nam, 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 nam. Eat the liquidity and then decide it wants to go down. All right? Or vice versa. Even if it wants to go up first, it might go nam, 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 eat this liquidity, and then start going in this direction. So therefore, that's already given me a plan of what I can do. What's a plan of what I can do? A plan of what I could do would be place my alerts, and when it nam, 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 eat that liquidity, then I can look and see what it wants to do. Am I going to get a correction? Am I going to get a continuation? That's what I can do. That's a great plan. That's a great playbook. Or I can turn and say, you know what? I actually don't like where this is in this bigger range, so I'm not going to trade it. I don't care about it. Maybe I'll watch it to see what happens, but I don't care about it because I only want to take the best trades because there's lots and lots and lots of other pairs. There's not just Euro GBP here and I've got a gun to your head and you have to take a trade. I can say, you know what? Based upon what Jay says, this doesn't look great. This doesn't really look like a 10. I'd prefer that we was on one of these yellow lines or close to these yellow lines. I really don't want to take a trade from the middle, which we call equilibrium, where the market is in balance, in flux, and there's not really no bias, before I get in on this trade. And if you said that, I'll be like, cool. That means you're waiting for this market to come up here towards this yellow line and start breaking structure, or get down to this bottom yellow line and start breaking structure for a counter trend, of a much bigger trend trade. Yeah. So for me, in regards to this Euro GBP there, I can't remember who asked me to look at it. Basically, I'll be saying, in fact, let me drop down to my hour time frame just to cement everything. All right. So on a smaller time frame from the hour, I'm going to show you what I would be doing on a smaller time frame. But on a larger time frame, I don't like it. So to be fair, I'll be like moving on. I'll be at least trying to go through all of my pairs to see what trades are sitting on that yellow line. What markets are sitting on this yellow line or sitting on this bottom yellow line? That's the first thing I'll be doing. I'll be sorting it out the wheat from the chaff straight away. Yeah, you stand over there. Yeah, all the lame one leg longer than the other, gold teeth girl over there, and the other ones can stand on the other side. That's what I'd be doing first. Yeah, before I can even see what the personality's saying and see, what the toenails look like. You stand over there because you've got one leg longer than the other, and hairy knees, and you stand over there. That's what I would be doing with my market straight away. And you can do this on a Sunday night. Go through your pairs and see where we're at. For example, I know if we go and look at GU, for example, and even then, even when we separate the wheat from the chaff, she looks good over there. But as soon as she starts speaking, she's an idiot, and she isn't somebody who you want to take a trade for. So what do I mean by that? I mean that even if we separate these markets and we turn around and say, okay, GBP USD, have a look. I apologize for my computer's moving so slow. Like I did that like 20 seconds ago. Maybe I need a restart. GBP USD. All right. On Owanda. Let's go on the bigger picture. Look, on a bigger picture, have a look. I'm looking at this and I'm thinking to myself, okay, nice dress. Nice smile, hair's done. Yeah, she didn't come out in a thong. Yeah, I'm thinking to myself, yes, look like it could be wifey. I'm looking at it, thinking to myself, it's up against this line. This is the bigger trend. Yeah, this is the bigger trend. We're up against this line. And it's a bearish market and a possible opportunity for me to get into a sell on a bearish market. That's on a much, much bigger picture. Now, even here, my point is that this one could decide, nah, mate, yeah, you thought it was good, but as soon as I opened my mouth, she had the halitosis. I'm sorry for my examples, but you get my point. All right. Yeah, it could still do this, but at least you've initially done some sort of filtration to be like, looks okay. It looks like something I want to get into. It looks like somebody I'd like to speak to. Yeah. Now at this point here is when I want to start grilling, start the questions. Walk over and be like, so how you doing? What do you do? What do you do for work? Oh yeah, I got OnlyFans, and it's just doing really well. I've got 1 million subscribers. You got OnlyFans, 1 million subscribers. Okay, maybe not wifey. I don't know, maybe. No disrespect to anybody out here is banging over the OnlyFans, and that's what you're doing. Good, but I'm just saying to you, maybe at that point in time, I make a new decision. After when I start to drill down and ask some more questions, get some more information. Get some more details about this market and have a look. For me, what does it look like in this market? Have a look at this. It was going sideways in this gray box. What does this look like? Somebody knows.
Showing bearish.
Yeah, but what happened outside of that gray box? When I draw any type of gray box, what happens either side of those gray boxes?
Liquidity builds up.
Liquidity builds up. And therefore, this little push over here, nam, is looking like what?
A liquidity grab.
And after liquidity grabs, more times out of 10, we see the market do what?
Run in the opposite direction.
All of those things have been true so far. The market's come up here, broken above our little grey box. Nam, with speed and strength. Push straight away back down here. You can see the wick showing that. And then the market is proceeded to make some lower lows and lower highs. Not on the 4-hour time frame as such, because we can't necessarily see it. But on a smaller time frame, if we was to go to, for example, hour, look at the structure. Let me try and... I'm trying to do this. I don't want to really start these charts again because the charts are moving so slow. But look at some structure. Look at some structure. Look at some structure. Yeah. The market has started to break down and past some of these structures, showing us indications and correction. On a smaller time frame, there's a smaller indication all the way up here. I guarantee you. So let's show you the strategy from back testing. All right. So if I was back testing this strategy, which you guys should be doing, I've seen this market go and push up aggressively outside of the range and possibly capturing liquidity or maybe indicating correcting and continuing. So I'm waiting, I'm dropping my time frame down. I'm waiting to see if this is just an indication. If this is the indication, then there's going to be a correction coming back down here. Then the market's going to continue back above here. Okay. Now I'm not believing that's to be the case because of the bigger picture. The bigger Russian dollars, we're right up against the top of that bigger line, that bigger range. And I want this market to start coming down. It will make more sense if the market starts coming down. Where's my line gone? I can't even see where my line is because it's at the top of that range. Remember what we said when we first opened it up? I said it's right up against the line. So on a 15-minute time frame, we can see the market's pushed up in here, grab the liquidity, started going sideways a little bit. Then we have an indication of what it wants to go and do, closing outside of the range. If you can't see the real range, it's in here. Watch. I'm going to draw a little box in here. The market pushed up in this is and grabbed that liquidity. And then when it grabbed it, it stayed up there for a little while. Admired the view for a little while. Watch it. Just up here, just having a look. Nice view. Let's go sideways. Let's go sideways. Then it's like, okay, let's go now. We're ready to go. And then it made an indication of what it wanted to do by breaking it down here. Yeah. And then we're waiting for some sort of correction, which you can see here, some correction. All right. And I don't know whether or not that's the correction, but let's look because we're going to do this in real time. Because even though we know where it's gone, I still don't know what the candle's done on a smaller time frame. I've just dropped down from a 4 hour to 15 minutes. So let's play it forwards. So I want to see a nice solid close below this wick. All right. I want to see a solid close. Now this close here, I'm a bit concerned because it's right on the wick. I'm just showing you from a 15-minute perspective. This close of this red candle is right on this wick. And I don't really like that. I want to see a close. And then afterwards, I don't see a close. I see it mucking around. Then I see another little wick mucking around, no close. And good job I didn't get in because boom, candles are starting to kick back in the opposite direction. All right. So though I've got this potential indication, this is all indication until I get a close below here to say it's correction. So now this green is looking more like correction. Let's play it forward. It's pushed up. This wick we can see is pushed all the way up into these levels. Let's keep pushing forward. You see, all of this here on this time frame, on a 15-minute time frame, it hasn't broken 15-minute structure. On a smaller time frame, i.e. the 5-minute, we can see a break of structure. Have a look. Maybe not. Have a look. Maybe not. Because look, when I'm looking here on the 5-minute time frame, look what this wick did. This wick did a lot of damage by pushing all the way down here. I can't see the 5-minute structure. What do I mean by that? I can't see my 5-minute valley and my 5-minute high. The 5-minute valley is looking at this wick at the moment. So therefore, all of this here was kind of fraff action because of this wick on a smaller time frame. Do you understand? Now, if that was me and I was in that, I wouldn't be in the trade yet. It's giving me no reason to be in the trade. And I saw it kicking back up in here. I know why it may want to kick back up in there. Somebody tell me why that market might want to kick back up in that level. Somebody tell me why when they see this market coming down here, it starts coming up here, why it might want to be kicking back on this level. It's not a trick question. Any question I ask you is about you looking at the charts and using the information that's available.
We'll be making a correction.
It's making a correction, but why up into here? Why might it be going up into here? I'm drawing it, guys.
To cover the imbalance.
Yeah. To potentially come and step into this. But remember, anytime there's an inefficiency in the market, You always in the back of your mind going, uh-oh, I owe man a little bit of money. You do not know when my man's going to come and collect that money. So in the back of your mind, every time the door knocks, you forget yourself, it might be him. You know what I'm saying? Yeah. That's when you see that imbalance, you're always going to be thinking to yourself that there's a potential the market wants to come and close that imbalance. Just play it forwards, see what happens. And the market actually came up into that level and didn't even get deep into that imbalance. It came close to it, tapped it, ever so slightly tapped it on a larger time frame. If I go to my hour, have a look at the hour. It closed the hour imbalance. The hour imbalance is here. Have a look. Remember 3 candle example that we spoke about? The 3 candles would be this green candle, this big red impulse candle that started doing something, and this next candle. That means that there would have been imbalance in between here and here, this point here, yeah? There and there would have been an imbalance. So the market came and it tapped into the 1 hour imbalance. It didn't get deeper into this 5 minute or 15-minute imbalance that I put up in here. And that's its own choice. That's just like, you know, Jason owes me £100 and JT owes me £20. And I go to Jason's house and I get my £100. I can't be bothered to go and drive all the way to JT's house to get the extra 20. I'll do that another time. Yeah, I came and closed that imbalance, which you can see here. These are the 3 candles. This green one here, this red one here, this red one here. There's a gap. Those 2 outer candles don't overlap. And the market came and closed that imbalance. And then within this little range, the market tapped back in here. And now remember, on the time frame, I said that the structure hasn't broken yet on this larger time frame, on an hour or even on a 15 minutes, because we had that mad wick, this little wick scenario. So all of this in here, I'd still be, if I wasn't in the trade, I'd be watching, thinking to myself, damn, this trade is mucking about, because this here is consolidate. This is sideways action. Let me draw it in here so you can see it. Get rid of that. Make it a color so you can see what I'm talking about. All that in here is it market going sideways. But now we've got an indication. So you've got an indication here with some candles closing on a 15-minute time frame, definitely on the 5-minute time frame. This would be some sort of correction. Let's see what happens. Oof. Oh, stop. My thing's moving so slow, they want to stop. All right. Indication, correction. Look where the correction came to. Exactly where. Somebody tell me. Somebody knows. Look at our range that it was consolidating in. Where did our correction come to? This is the range. I'll draw the box. Where did the correction come to?
Roughly 50%.
50% of that range of where it was consolidating. And therefore, when that market came up here, if he was wicked and bad, I'm going to show you something. Here's where Jay would have got his entry. Because I'm wicked and bad. All right. But even if he's looking on a 50-minute time frame, when that candle closed below here, indication, you want to look for a close below this wick, correction, continue. When that mark candle closed here, you would have been able to, it's not the greatest of entries, turn around and say, I'm taking that trade here, and I'm placing my stop above that high. You could have been able to do that. Now, if you did that, you would have to be target. Go on.
Where did you say your entry would have been?
My entry would be on this white line, which I'm going to show you in a minute. All right. Because as I've seen this indication, that's just broken out of this structure. And I've got the added confluence of what? Being where in the range?
Top of the range.
Top of the range. So this is indicated and I'm excited. Then it's corrected back to 50% of the range. I'm excited. And it's at the top of this area of I want to be selling from. Do you understand what I'm saying? Yeah, I'm excited. So if I want to have a look, I'm going to put a vertical line. I'm going to show you the entry, which is going to be closer up into that range. I'm going to be watching that impulse. Have a look at the market pushed up like this within this range. It's the exact same strategy. I've just gone to a smaller Russian doll. All right. Let me change the color of that. The exact same strategy, but a smaller Russian doll. Watch this. I'm going to drop down to my 3-minute time frame for argument's sake. Just because I know I'm going to get what I want there. But let's stay on my 5-minute. I tell you guys never to go down below 5 minutes. Let's stay on 5 minutes. Have a look. As it came to that level, I am licking my lips. I've seen it come up to the 50% level. Now, at that point in time, I don't know if it's going to keep going. It might have just started raging up here and doing something else, but it doesn't. At that 50% level right here, the market starts pushing down in these type of areas here. And on a 5-minute time frame, we get a break of structure here. It's not great on the 5-minute time frame. But here would be an indication. All of this would be indication, to be fair. This here would be continuation. Correction. And this here would be continuation. So for me, I'd be a bit smaller in here. And I'm going to just show you it. I did want to go to my 3 minutes straight away, but I'm going to be a bit small. We don't know. I'm not every single time, it's not going to be that you have to go small. I'm just saying, as a newbie, as people that are new to the strategy, it wouldn't be responsible for me to be telling people to go down to like 1 minute time frame. But have a look. I'm in here. I've seen it touching here, and I'm very concerned about this structure being broken on a. Oh, this is 2 minutes. I thought it was 1 minute. Let's go to 1 minute time frame. Okay, it's the same strategy. The only thing is now, remember what our Russian dolls? Oh, come on, man. I don't know. I'm really gonna have to reboot my computer. I don't know what it's doing. All right. I'm going to be looking. This is like the smallest Russian doll now. 1 minute time frame. And this structure here is the place I'm looking at. So when market comes up here and starts doing all this, I don't know what it's doing here. I can't say it's going to be falling to hell now. I don't know. Hasn't even broken 1 minute swing structure. But here, when this market breaks it over here, have a look. And I started getting closes over here. Can you see these candles closing? So I'm waiting for a correction. I get a correction. Look at the correction. This is the correction. This would have been the indication. Let me draw it for someone who can't see it. This would have been the indication of what it wants to do as it broke this 1 minute swing structure. This would be a correction. And then therefore I'm waiting for a continuation. Boom, there. So whereas I'm showing you the exact same strategy. The line I drew previously was over here. But it's actually over here would be my entry. Jay would have, and yourself, as and when you get more and more comfortable with the strategy, would have been able to enter this trade over here. Now let me show you. From here, you have some options. You're either going to be uber aggressive, placing your stop above the last high here, or you're going to be safer and place that stop over where it was over the swing high. Now let me explain to you the two options. One option's high risk, high reward. Very high risk that you're going to get stopped out by a little bit of volatility of this market coming down here and then kicking back into this level and then going to hell. However, the difference in risk to reward is going to be substantial. Okay. Now, one of them requires you to have a thicker skin if you get stopped out to be able to get back in the trade and to be active in the markets, as in be able to be sitting around watching what's going on. And one of them is that you're going to set it over here and you're just going to go about your business and you're going to have a little bit more freedom to check it in an hour or check it in wherever. Either way, have a look at the difference. That's one of them. I'm just sorry that my chart's moving so slow. So every time I'm moving the mouse, everything's happening like 2 minutes later. Yeah. Look, there's an option. There's a difference. Now, if I was in this trade and I got into this trade here, and I'm thinking to myself that yes, this market is trading down within a range. I'm not just saying, yeah, I'm trading it to my yellow line, because my yellow line don't mean nothing. My yellow line isn't, set in stone. My yellow line is a range, a guide to show me what the market's been doing. But what is set in stone is market structure. So if this market is supposed to be trading down now after grabbing liquidity, it's supposed to be breaking this level here. Let me make it blue so you can see what's going on. Because it's supposed to be breaking this level, because it's supposed to be making lower lows and lower heights. It's supposed to break this structure in here. Because it's supposed to be making lower lows. So this is a level of structure. If I was to draw another angle in here, which I'm reluctant to do, but let's just say the market was pushing up like this. The last swing low before that highest point. If it's now coming down and it's supposed to break this level. So this is a great target, or someone could turn around and call this a TP, whether that's going to be TP1 or TP2, that's down to you. This is a target. And at that point in time, the question I got to ask myself, remember what we started off the session with, is if I took that trade ultra aggressive or conservatively, well, that first one here is showing me a 1 to 2.6. Have I won? Am I happy with that? Should I bank any profits with that? I put out 1,000 quid, I'm up 2,600. I put up 100 quid, I'm up $260. The one that's more conservative. Oh, wait a minute, I'm wrong, sorry. The aggressive one is a 1 to 7. Sorry. Yeah. The conservative one is a 1 to 2.6. I'm just going to round up to make it sound better, 1 to 3. But at 1 to 7, the question you got to ask yourself is you're in a 1 to 7 trade. You've just come and nam, eating the liquidity from below this area. Have you won? I think I've won. I think there wouldn't be no problem in me turning around and taking my profits at 1 to 7 and saying, yeah, yippee-ki-yay. Or if you don't want to stop yourself out of a trade, move in your stop loss right up the arse of your position like this as it was coming down, on the basis you're saying to yourself that I kind of want to stop myself up. I want to stay in the trade just in case this goes to hell and the sun's shining on me. But really, I don't want to lose any money from taking a 1 to 7 trade. You put out 100 quid and I came back how long later? What is that? It's 5 minutes time frame. Let's see how long I took. This trade took. I came back 2 hours and 45 minutes later with 700 quid and I left it on the table and you didn't want to take that money and put it in your pocket. You just was looking at it going, well, I'm not too sure. Maybe you could do a little bit better. Maybe, Jay, I'm thinking to myself, if you go for another 2 hours, you're going to bring back 1,400. You wouldn't do that. You'd be like, rah! That's the flip, yeah? $1 to $700 in 2.5 hours. I'll take that. Thank you very much. And put that in your pocket. Because at this point, when we come down to the bottom of the range now, what are we expecting? Bearing in mind the market's moving waves. And we've made a lower low now. What are we expecting now after this has happened?
The reversal.
Yeah, we're expected to kick back on us to some extent. So if I'm up $700 and I've quote unquote won, or even if I took the lower risk one. Now the lower risk one's different because you might say, you know, I'm at 1 to 2.6, my stop's all the way above this swing high. I'm going to stay in this trade because I want this market to get back to a larger structure. If you said that, cool. If 2.6 wasn't winning for you and you wanted, you know, your target was 3 or 5 or whatever, maybe, cool. But on this lower one, I'm taking my money. Let's play it forward, see what happens. I don't want to sit in here, look, and feel like a mug that I was $700 up now, and now I'm back to $200 up or $150 up. Why would I want to do that? If the aim of the game is me making money. The aim of the game isn't me being a guru and me knowing what the market's going to do for the next 10 years. Somehow that gives me some sort of, that's going to pay my bills. That's not going to pay your bills. Might make you feel good. I told you that Bitcoin was going up. Okay, did you buy Bitcoin, bro? Or are you just a guru? Or are you just out here just tossing out nonsense? No, but I knew it was going to go up. But get lost, bro. Yeah? The aim of the game is to you to be able and say, look, I've won. I made that 1 to 7 here. I understand we're at the bottom of the range. And then when the market comes back up here and starts going sideways, what have you got the option to do once again? What have you got the option to do? The only difference is now you've got $700 in your pocket. You've got the option to go and get back in again if you really wanted to. Because what you're going to do, you're going to watch it again. Look at the market's going sideways in here. Look, all of a sudden again, look, the market's come back up to the top of the range after being bullish. And then I was thinking about it again. And if I was in this market, I'd be sitting here saying, okay, just made $700. Maybe I've left for the day and I've closed my computer. Maybe. But if I haven't, here we go. Look, I'm waiting. Oh, it's a big old indication. That's a big old indication of what the market might want to do. Now, this is good as it goes. This is a good example. When it made this big indication, what is my immediate concern about this big indication? What's my immediate concern of what the market may want to do?
Close the imbalance.
Close that imbalance. That's my immediate concern. Because even if right now that market makes a correction and closes down below, in the back of my mind, I'm still being thinking to myself, right, this imbalance, bro. I owe this money, man. The man can knock on the door any day. I'm really concerned about it. Let's play it forward to see what happens. Oh, tapped into the imbalance. Tapped into the imbalance ever so slightly. Came down here and let's have a look. On the 5-minute time frame, do we get a close in? Not really. Not really. It didn't really get a close here on the 5 minutes. Here's the close. Here is the close on the 5-minute time frame for sure. Yeah, but on a 5-minute time frame, just here, let me move that little blue TP. All right. We didn't quite get a close below this level. So on a 5-minute time frame, it might have been difficult until here for you to turn around and say, I'm going to get in. But even if you was going to say you're going to get in here, in my opinion, A, you're in the middle of a range, which is a concern, but you're going to have to take into consideration that imbalance. I'm sorry. So that's going to be at least 30 pips. So I'm sorry about that. You're going to have to take that into consideration. On a smaller time frame, you may have gotten in. On a smaller time frame, you may have gotten a 1 or 2 minute close here and been able to say that's a close below hand and you're going to get involved. Let's play it forward and see what happens. Market continues to push down, making lower high. And then we've seen over here, even though this is pushed up here, on a 5 minute time frame, it hasn't broken on the structure. On a 5 minute time frame, the structure is here. Go on. On a 5 minute time frame, here's the structure. So even though this market is kicking back here on a 5 minute time frame, it hasn't broken structure. On a 1 minute time frame in here, it's very highly possible it's broken some structure. But we're looking on a 5 minute. Let's see what happens. Now it's broken that structure. Just about. This volatility here was some sort of news that came in there. Look, that basically wiped the books. It cleared the books. Zoop, zoop. It cleared the books of anybody that had any smaller positions in here. But traded back up to the top of our range in the premium. Let me show you something here on a smaller time frame. Maybe, I don't know if we're going to get it, but maybe I'm going to drop my time frame all the way down to my 1 minute. And then when that market pushed up here and got to the top end of our range, if you was wicked and bad, I'm trying to see if I can't really see it, to be fair. You're going to have to be even smaller than a 1 minute, which I wouldn't advise anybody to do. Okay. But I guarantee you, in here, there is the exact same thing happening. There is an indication on a smaller time. In fact, let me show you. I'm going to go to my 15-second time frame, just so you don't think I'm fraffing. This is 15-second time frame, meaning every single candle is 15 seconds in time. Well, here, even when we look here, this would be the impulse that it's been trading up within. And also there'd be an impulse like this from this wick going all the way up in here, which is an even smaller time frame. And in here, up in here, there is an entry, but I'm going to show you here on this 15-second entry. I am waiting for this structure to be broken. This is the only thing that's showing me some structure. It's showing me a 15-second low here. And then we can see some structure here, some structure here. When that market indicates past this structure, corrects and continues, I have the ability and the choice of getting into this trade extremely aggressively above this last high, which is 5.5 pips, or I can place my stop above the swing high. Now, what I would be doing is this. If I did drop to my 15-second time frame, I want to place my stop above somewhere else that has a stronger time frame, has structure on a stronger time frame. All right, so let me skip to my 1 minute for argument's sake. It's pretty hard to do because we're just getting all red candles. Okay. Now, here potentially is a little area, not great. Above that little wick high is another area for 16 pips. Yeah. But I have the option to. Now, the reason why I'm saying that is this. These red candles are misleading because they're red. If this was a black and white chart, this push up here becomes a level of structure. Hence the reason why I've said over here is another place. Just like over here is another place of where the market came all the way down here, this green candle, and then pushed all the way back up before opening this red candle here is another level of structure. That's because I'm reading the candles, not just the colors of them. The colors of them is a junicle. It's like a new kind of thing where they're giving you colors. But back in the day, traders had black and white charts, looking at the actual structure of the candles. It helps a little bit sometimes when you go to the line chart, because then you can actually see where the bodies of these candles and these movements were. Okay, but either way, on a very small time frame, that would have been an entry. This is the aggressive entry. Say if entry is above this high, middle. Let's see what happens, and then we can finish up. Now, the only issue I'm having here is ultimately you're in here on this smaller range. You are in the middle of the range. You know, so taking this trade, this is the safest place to place my stop because I'm in the middle of the range. And in the middle of the range, this market can choose to do what it wants on a short term, but on a longer term, I'm not expecting it to break up this structure. So personally, in this instance, if I had to, and I took that trade down on 50-second time frame, I'd probably want to place my stop above here. It's not that bad anyway. It's only 28 pips. It's not end of the world. Let's see what happens. On the aggressive one, it's all the way down here. So you're kind of running the risk that anything can happen. But I'm going to put them both in so we can see which one wins, which one doesn't. My chart's moving slow, so I apologize. And let's hit play. And I'm going to play it very quickly so we can finish up. Boom. See what happens. Profitable. At the bottom of the structure, I'm concerned anyway, so at that point in time, we'll be taking some profits. Now here, I'm expecting my low risk trade, my low risk position here to still stay safe. All right. Obviously, look, we would have taken our profits down at the bottom of this range here, but I'm just saying, as I'm playing it forward, the low risk place where I place the stop above this high, I'm not expecting that. In fact, I'm lying. You can see this little imbalance still here, so I'm concerned about it. But either way, I'm expecting that this to be a safer place to place my stop if I forgot about this trade. Yeah, I'm not expecting this market to go up here, which I'm going to kind of backtrack on because of that bit of imbalance. All right, really, it should be above that imbalance. And as you can see, the market hasn't. The market's come up here. I can see my previous drawings. And it's consolidated. We're now on the top of that yellow line again. So can you see my point? The difference between taking a lower risk stop above a swing high and a very aggressive stop above the last high means that you cannot fall asleep on that trade because it could kick back on you, and therefore you haven't placed your stop in the safest place. And in regards to this stop here, I'm going to make this 5 minutes. It's taking too long. In regards to this little stop where I said over here, I am a bit concerned because I didn't put it outside the imbalance. All right, but let me just quickly play this forward, and then we're done. Market's going sideways. Market's taking liquidity from both sides, took liquidity from below the range and took liquidity from above the range. And now we're currently here. And in my opinion, like I said, after taking this liquidity from above here, when it should have broken here in line with this line, this was just it going nam to continue its journey. I'm expecting this market to continue being bearish down here. Unfortunately, I wasn't around when this first little liquidity grab happened. But if this structure breaks here, this would be you waiting for an indicate. This would be your indication. Then you're going to wait for some sort of correction and some sort of continuation to potentially take this trade at least down towards this yellow line, and more importantly, down towards structure in line with this yellow line. So structure meaning here. All right. So that's what you're waiting for. So if you want, pop an alert below this little level in here. Right click, add an alert, crossing down. When that crosses, I'm not just going to jump in, because if I just jump in there, I'm going to have to place my stop all the way at the top of that range, which I don't really want to do. I'm going to wait for it to do what it does, pushing down here, and then hopefully get some sort of correction. And I'm going to get on the continuation, hopefully looking something like this from the top of this range. On the basis that, I need to zoom out, I can't remember what the bigger picture is. On the basis that we're going to be coming down from up in these levels. I can't even see here, I've got two mess. Yeah, on the basis that I want to see this at least get to 50% of this previous consolidation. All right, at least get down to 50%, which is about here, of this previous consolidation. Ultimately break straight through that level and keep going down bearishly. Why do I say that? Because my bigger Russian doll has told me that realistically it's good for a sell, this market. And there you go. Guys, good morning. God bless. I don't want to take up too much more of your morning. We have run over a little bit, but I hope that you've learned something. Okay, for the people that have been at home, that are locked in YouTube,